Andy, what's the immediate impact you're watching, and how significant is the disruption likely to be if we do in fact see this hurricane intensify to a Category 3?
Well, thank you very much for having me. I think the impact of Hurricane Idalia on the energy infrastructure is actually very small. The majority of natural gas and oil production, if you will, is to the west of Mobile, Alabama. So if you would draw a north-south line through Alabama, the impacts are going to really be to the east side of that. Florida produces only 2,000 barrels a day of crude oil, while the nation is producing 12.8 million barrels a day. What I'm really looking for is the supply disruptions coming from tanker deliveries of gasoline and diesel being delayed into the port of Tampa, as well as along the Florida panhandle from Pensacola over to Panama City.
Andy, if we do see that, what could that potentially do then to prices?
Well, in the local Florida area, we would expect that prices go up. And the biggest concern is flooding and power outages of these terminals that are against the Gulf of Mexico. And should the storm surge come and impact them, then you can see a more difficult situation as gasoline supplies into the panhandle have to be trucked in.
Andy, as you look at this as one factor in oil prices and where they are moving right now, how significant is sort of when you look at the global factors right now? I mean, how big of a mover is this likely to be in the grand scheme of things?
Well, the storm is actually going to be a very small impact on the overall oil market. For the global oil market, what we've really been focusing on is the production cuts that we've been seeing out of OPEC Plus, specifically Saudi Arabia, as they try to get the price back towards $90 a barrel for Brent crude oil. And we've seen Saudi Arabia impose voluntary production cuts that I expect that are going to continue through October and perhaps through the end of the year.
Andy, how do you see the demand picture globally, factoring in China, the slowing, very slow recovery that we're seeing there, how that could potentially, I guess, keep oil prices in check? Because we kind of have this push-pull going on between demand out there, falling demand, and then the supply picture and what that could look like.
Well, the oil market has been, frankly, disappointed with the reopening of the Chinese economy and the rate of growth that we're seeing in oil demand. In the second quarter, Chinese oil demand was still a very robust 16 million barrels a day, second only to the United States. But we expect that demand is going to start to slacken in the third and fourth quarter. And that is why we're seeing Saudi Arabia take these preemptive measures in order to get the oil market back in balance. I should also add that while OPEC Plus has been trying to cut production, members of OPEC who are not subject to the quota, like Libya, Iran, and Venezuela, they slowly but surely have been increasing their oil production. And that's really thrown a monkey wrench into Saudi Arabia's plans.
So when you consider that OPEC Plus has cut roughly 5 million barrels a day since October of last year, you consider the softening demand out of China. What are those additional cuts you alluded to earlier? What does that look like?
Well, when we saw the OPEC Plus production cuts, of course, that was from their quota levels, which were in excess of what they were actually producing. So in reality, the OPEC Plus production cut of a headline of 5 million barrels per day only translated into about 2.7 million barrels a day, offset by what we saw come out of Iran and Venezuela and Libya. And that is really the difficulty that OPEC Plus is having, that they haven't cut as much as they've announced. At the same time, the International Energy Agency is predicting a record oil demand this year, up 2.4 million barrels a day from last year, but a much slower growth going into 2024 of only 1 million barrels a day. And fortuitously, the U.S. is supplying a significant amount of that increased oil demand through our increased production.